Hi and welcome to Swissquote's Daily Market Talk. It's Monday, May 19th. Market mood this Monday is much murkier than a week ago as Moody's just became the last big rating agency to cut the US credit rating below the top AAA range. And the US Treasury Secretary Mr. Bessent warned that the 90-day tariff pause period could come to an end prematurely. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the week starts with a jump in US yields and a weaker US dollar after Moody's downgraded the US credit score from the top AAA to AA1 on concerns about the US rapidly rising debt toward the 37 trillion US dollars mark, and the US budget deficit also reached 7%. Note that this is the highest range in the peacetime. So note that Moody's decision is nothing surprising per se, as S&P and Fitch, they have already lowered their American credit rating below the top AAA range, and if they don't do it, the problem is that they lose their own credibility. Now, there are some posts out there suggesting that Mr. Trump threatened the credit agencies with tariffs, which wouldn't make sense anyway because these agencies are mostly American agencies. But the Treasury Secretary Scott Bessent downplayed the credit downgrade and tried to attract attention to the sharp tariff hikes that may be announced within the next 2 to 3 weeks, as the trade negotiations with most nations, most trading partners, has proved to be quite complicated, and that the American administration apparently is not very happy about it and started accusing its partners of not negotiating in good faith. They are probably shocked by countries defending their own interests in this trade war, and that the tariffs will, as a result of it, reimpose before the end of the 90-day pause period, and maybe, but just maybe, help refill the coffers of the United States in the short run, but in the long run it's going to be complicated. Now, all in all, the Trump administration is proving again that their word and their promises could not be trusted, because there is no possible predictability or no possible reliability in their promises and in their announcements. Their promises and whatever they announce could change and reverse unilaterally at any time, and that's cause for concern. So negotiations could hardly go well in these conditions, as what the US administration expects from these negotiations and from other countries is costing a lot to the rest of the world. And negotiations could go well only and if only two sides think that they are winning. So this is how I see the problem. So that basically means for the market that volatility will continue. Market mood that had improved just a week ago after the US and China agreed to talk while lowering their tariffs on each other for a 90-day period that we don't know if he's going to stay or not, could also fall under a bus at any time. And the realization that pure optimism is a premature answer to the trade news should bring capital back toward the safe haven assets, including gold, obviously, that saw its price retreat over the past 2 weeks on de-escalation. So gold could return back to the uncharted territories with the revival of the trade worries. The Swiss franc and the Japanese yen could also amass some safe haven flows, and the euro could also see some inflows into the region along with the European sovereign bonds. Note that the German 10-year bond yield has finished last week below the 2.60% mark on increased demand for the country's sovereign papers that, by the way, continue to offer a solid AAA rating to its investors. As such, it stands this Monday at a stronger alternative to the US sovereign papers than it did last week. So before we move forward to what to expect from this new week, it is, I think, important to note and to dive into what this credit rating means for the markets and investors, because it is not just an indication of risk, but it actually does have concrete implications for portfolio allocations, because investors could put their holdings as collaterals to leverage their investments, meaning that they could invest more in riskier assets by showing their, say, safe holdings as collateral. The riskier the assets, the less they are worth as collaterals, and the less they are worth as collaterals, the more investors will be asking for a higher compensation for holding them, which probably explains why the US 10-year yield is up by 1.7% this morning at the time I'm talking here, and why the US 30-year paper is up by almost 2% at the time I'm talking here. So, higher yields weigh on sentiment this Monday. The US futures are pointing at a negative start to the week, while the European futures are also under pressure this morning. I'm talking before the European markets open. But the pressure here in Europe seems softer on the European equities this morning than on the US. Peers are dealing with this credit downgrading issues. We could also see the big tech rally of last week soften in the US after an impressive rally that pushed Nvidia past the $135 per share level on the announcement of last week of massive deals with the Middle East government despite the chip restriction issues. Now, note that the trade risk persists because Apple was told, for example, last week that their plan to move production from China to India was not enough to satisfy Mr. Trump, who actually wants Apple to produce its iPhones in the United States. On the other hand, Meta, Google, and Microsoft, that were spared from the tariff ping pong of this year, could also come under an increased pressure if the fruitless negotiations between the United States and the European Union lead to the end of the 90-day pause before the deadline is reached, in which case the European Union countries could retaliate on the US big technology services. In Asia, the week starts with losses in major indices. The Nikkei is pressured by stronger Japanese yen, and the CSI is down this morning. China actually printed a smaller than expected slowdown in its April industrial production, but retail sales in China slowed more than expected as well, weighing on hopes that China's domestic market could help making up for the slump that we see in global demand due to the trade war. The Hang Seng Index, on the other hand, in Hong Kong, kicked off the week on a bearish note, but the index actually sees some dip buying before Baidu, that's active in AI, and Xpeng, which is an EV maker, a Chinese EV maker, announced their earnings later this week. Also this week, Cattle IPO is going to be on the close scrutiny. That's the biggest IPO of this year so far, and that's just due in a few hours in Hong Kong. The world's biggest EV battery maker, who counts Tesla, Ford, BMW, Mercedes, and Volkswagen among its biggest clients, is expected to announce the final price offer today and start trading the next day in Hong Kong. On the economic agenda this week, the Chinese and Australian policymakers are expected to cut the interest rates as soon as this week to counter the negative impacts of the trade uncertainties and the trade war on their economies, while the United Kingdom is expected to announce a jump in its headline inflation on Wednesday morning. Then the flash PMI data will land on Thursday this week to give us an idea about sentiment on field. And the US manufacturing PMI may have slipped into the contraction zone in the month of April due to all of these trade shenanigans, according to a consensus of analyst estimates on Bloomberg. So soft data here could obviously revive the Fed cut expectations, but whether the US Federal Reserve will be capable of cutting its interest rates will depend on the inflation dynamics in the United States, and with the tariff threat prematurely back on the table, the Fed bets will likely see hard time picking up positive momentum and help fueling the positive sentiment. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.